super panel here today. We've got Norbert Kellner, who's head of syndication for Berlin HIP. We've got James Matthias, who's a portfolio manager for real estate debt at PGIM Real Estate. We have Matthias Sandfort, who's a group head of debt finance for CORESTATE Capital Advisors, and Ali Imraan, who's managing director for debt investment and special situations at LaSalle Investment Management. Let's start with you, Matthias. I just wanted to pick up with you, I suppose, how you've seen 2020. How do you characterize that as a year, particularly when you're looking at the sort of debt finance and the debt investment markets?
Well, not that easy to answer, and to say something different from what we all know, but the pandemic influence on the real estate market and also on the availability of debt is tremendous. If I focus on the banking market, when it comes to the private debt market, I think that the private debt market has seen that as also as a chance to improve their business and to widen its activities. And from what I said earlier, as CORESTATE pursues several strategies, so we also took advantage of that situation that the private debt market is more liquid as it was before. However, when back to 2020, so it was very much influenced on the hospitality market and the real estate market due to the lockdown, so that finally will get and will be reflected in the covenant regime of all loan contracts, and there's something to work on in 2021.
Okay, good. And from your perspective, Norbert, I suppose looking towards 2021, also in terms of your view as a senior lender, I suppose, how do you characterize 2020, but also how are you seeing the kind of current market in 2021 and I suppose looking slightly forward?
Yeah, the year 2020 was, of course, a special one, and I guess we can all remember very well, let's say, the time at the beginning of the year start as normal, then I guess it was February, March, when COVID really came in, popped in, and had instantly a very huge impact. So the second quarter was one where we all thought that the year would be not a good year, definitely not. So we all, started doing our project and portfolio management. We tried to figure out what could be the impact on ratings, what could be the impact on several transactions. So I would say the markets, and we all were a bit nervous. And then during, let's say, or by the end of the second quarter, it looked more and more stable in a way, because it was relatively clear what's happened. The impact was, from my perspective, then of course not entirely clear, but we could see a bit that there were some key issues with some specific asset classes, for example, and we could also see that in some other areas, some other asset classes, the impact was rather low. So I guess with some changes in the strategy and the origination, etc., we were relatively early then in the third quarter, let's call it, back on track. And then, in my opinion, the fourth quarter, as well as the third quarter already, was relatively as normal, you can say, just business-wise, of course. Yeah. So in my view, and that was, let's say, also the result for 2020 on business terms, it wasn't too bad. The negative impact was relatively okay, in a way that we could all concentrate on right business in our view. What fit to us, what was the right risk, let's say, for what we see was at risk, and in the same way we turned into 2021, in my opinion. So what we could see, again, figure-wise, last year was absolutely okay, and the year 2021, at least, let's say, for the first quarter and the beginning of the second quarter, is quite good. And assuming that maybe the COVID-19, we see in almost all countries a bit of light at the end of the tunnel, we are expecting that maybe with just a few really kind of points where we have to work on, some are already mentioned, like on retail, hotel, etc. We imagine that the year 2021 will be relatively good, as well as last year. So that's maybe a very rough but first impression from my side.
Okay, great. Thanks, Norbert. Deepak, maybe just coming to you in terms of some of the key trends. What are you expecting to see? I suppose, what are you seeing at the moment? I mean, we've mentioned some of the things there from the pandemic and how we're seeing it. But what are you seeing, I suppose, in terms of key trends for people to think about for particularly this sector?
Yeah, I think generally, like in 2020, there was a shift to, in focus to core like real estate fundamentals such as income, cash flow, and covenant strength of the underlying real estate. There's definitely been a flight to quality across all asset classes with a sharp focus on sponsor capabilities and track records. And we've also seen the emergence of a lot of new debt funds, right? A lot of them who would have been predominantly on the equity side previously, but they're looking at generating target returns on a risk-adjusted basis, similar to what they would have done had they been owners of these assets. So that will be busy. We're certainly starting to see banks returning to the market, albeit at generally lower levels of pre-COVID LTV. So typically 50-55% LTV, albeit with some amortization. There's strong demand for like the beds, sheds, and the medical sector as well. And office is polarizing lenders. We're seeing a lot of varying opinions about it sector. Not sure how people return back to the office, and that's filtering into the debt markets as well. I think hospitality is kind of returning, and people anticipate a bounce back there, particularly in leisure hotels. And then retail remains very, very tough. Many lenders have a blanket policy of no new retail offering. We have looked at one high street retail opportunity where we managed to get 55% LTV, but that was on a full recourse basis. And anything with full spec, lenders are very, very adverse to that, with uncertainty around how people will return, whether it's industrial, offices, anything spec is on pause generally.
That's interesting. And Jamie, from your point of view, I suppose when we're looking at challenges, is that uncertainty still the key challenge in the market? Do you think? How are you seeing things at the moment?
Well, I think the uncertainty extends through to, as Deepak identified, different property types and different areas. And so as an investor, we're focused on the underlying cash flow profiles of the different investments that we make. So as you look across a range of different strategies, there are different opportunities that emerge as a result of that. So I think as we've seen the market evolve over the last year, you've seen that those sectors that offer a degree of cash flow certainty have really been subject to a degree of crowding amongst a significant lending community. And then those sectors that have less certainty are actually resulting in some increased sort of interest from risk-adjusted opportunities going forwards. But it involves very significant caution, very careful underwriting to try and make sure that you're identifying specific assets that are going to perform as we come out the other side of it.
Okay, good. And Ali, just coming to you in terms of the I suppose the appetite for debt as an investment. What do you? I mean, obviously, when we look towards the sectors, there's been a huge focus for investors on logistics and on residential, for example, and meds, as Deepak pointed out there. But are you seeing also an increase in demand from investors for debt investments?
Yeah. So look, I think one of the key things that is driving the investor is if you look at the universe of kind of like LPs. There is still a big hunt for yield. So if you look at all these portfolios, any investor, any LP is looking for somewhere between sort of 5 and 8% on their overall portfolio, right? And historically, a big part of that has been in fixed income assets, and for a while now, that has just not delivered the yields that you need. And so like that's kind of that's had a sustained systematic move towards private credit. Corporate credit is also has benefited, so has real real estate credit, infrastructure credit. So I think there's a wider theme that's kind of happening there. In terms of what investors are looking for, I mean, I think you have to really think of it exactly like you do equity, right? So if you take an equity strategy, people go, well, from a risk reward perspective, some LPs want to be in core, some want to be in core plus, some want to be in value add, and some want to be in opportunistic. And I think as a debt investor, it's the same analysis they're doing. So they're sort of going, hey, I want to be in senior loans, or I want to be in whole loans, I want to be in transitional or mezz, or I want to be in very opportunistic. So I think that demand is very broad-based. If I take a step back and look at what's going forward, I think the demand for the interest rate environment looks, for now at least, quite benign. And so, like, you know, that yield, that hunt for yield is still going to be ongoing. And I think if you take a look at US as an example, I mean, in the US, I think about 25% of the market is actually non-bank lenders. That's debt funds, insurance companies. In Europe, I mean, the most advanced market is actually the UK, and that's still under 10%. If you take continental Europe, I mean, the banks and the kind of the covered bond and brief markets, especially in Germany, make up around 90% of the market, right? So whether it ever gets to the 25% in Europe, I think that's open for debate, but the direction of travel is very clear. I think there's a clear sort of pullback on the banking side in terms of what they really want to focus on. So I think, like, in a way, if they like something, it works really well. But there's a whole host of other things where opportunities are opening up, and that's for debt funds like ourselves, but also for insurance companies and for other forms of financing as well. So I think this is a very broad-based kind of shift towards appetite in terms of debt for investors.
Okay, good. I've got a quick question come in from Oliver Platt. Oliver, thanks very much for joining us and for your question, which is, do you expect an increase of NPLs due to COVID-19 in the European markets, particularly the German market, and hence a comeback of NPL transactions? So I don't know who was. Does anybody want to pick that up? Has anybody got a perspective, particularly on either the NPLs for the European or German markets?
Well, let me start with the first comment. It is about the way you understand NPL. So if you say this is a short period only, so sit and wait, that might be a chance to come out of the mess, whatever presses you in your lender's relationship. But if I would say let's start with that. But Ali and Deepak had that earlier. It very much depends on the underlying and the asset class and the future prospects. So if we talk about retail, it's not all the same. So food retail is outperforming, super good, and increasing prices. But for high streets in B and C city locations, so we will see how the future develops. So as a lender, you're better focused on that, on capital strength, blah, 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 all these financial covenants you typically have. And this question, what is a typical non-performing loan is not that easy. It's very much the way you understand it. So a covenant breach, it's only does not really provide you a loss given default at the end.
Maybe I would add something on that, because I think Matthias is fully right. What I would say is, you see kind of two perspectives. One is, let's say, what was more the shorter term is what is the impact of COVID-19 on our tenants, for example, as a senior lender. And of course we see that there were of course also a bit of nervosity let's say last year, and we thought that maybe we have a huge impact more or less instantly, and what I can state is that so far we've seen only some covenant suspensions, some amortization suspensions, not really big issues, right? Of course, this is also linked to a massive support by all the governments, yeah, absolutely, and we will see, and that's maybe one key question, what will happen if this is rejected, yeah, definitely. But what I think is maybe also paying into this discussion in regard to the question is, what is the longer term impact? And of course, what we've seen is that COVID is a bit of an accelerator on changes we've seen already before. Let's have all this discussion on what's the impact of home office into the office market, or what's the impact of online trading on all the retail, right? And I think this is, of course, an impact where we have some ideas. We haven't seen really the full picture, and if this continues, I see definitely a few pockets from investors as well as from banks, where those investors and banks have to think about, is this portfolio the right one I want to go into the next 5 years? And then I think maybe it's not really the typical NPL trading, it's more the portfolio trading, where people decide to, let's say, calibrate their portfolio.
Okay, good. And does anybody have any concerns over, I mean, obviously everybody's been very focused on the immediacies of the health crisis, and the governments have all been supporting the economies, putting huge amounts of capital in. But as that money begins to be removed from the market, and we begin to see what businesses are actually out there and the economic hit from that, do we expect that to create issues? I mean, Norbert, you mentioned there, the occupiers. Does anybody have any concerns that, there'll be a period at the moment which will be fine, and then there'll be an economic recession which may well create issues and non-performing loans?
Sorry, James, go ahead.
I was just going to say that, the consequences of loan performance take a while to shake out through the system. And I think you see that across different property types differently, as we were sort of alluding to before. So some of these effects are just going to take a little while to come through the system. And as you say, Richard, those economic effects will take a little while to filter through. But you're going to see that there are portfolios that do underperform eventually, and those opportunities will be out there to look at very closely. Sorry, Ali.
No, I was going to say, the bit I was going to add was, I think, look, I mean, there's been a lot of government support. I mean, there's a lot of liquidity in the market, right? I mean, it's very, very hard to have a, broad-based economic shock when there's this much liquidity in the system, right? So, and I think, obviously, that is by design. So I think, the real question is what James was sort of trying to answer as well, saying, look, I mean, which sector is where the fundamentals are shifting under your ground, right? So if you look at retail, that's the most obvious one, where, it's very apparent. And I think a lot of people asking questions about offices as well. I mean, at LaSalle, I think we are relative kind of bulls on offices, in the sense that we think there is definitely change coming, but it's a stock picker's market, right? So you kind of have to really focus on where you think the fundamentals are very strong. So if you're looking at a city center office in Munich, I think as long as you have the right capex plan, you can be pretty sure over the next 5 years you're going to be fine. But if you're in an outskirt location in a B or C city, I think you're probably more worried, because the actual impact of whatever change is going to come is probably going to hit you disproportionately. So I think the real question to ask is where are the fundamentals shifting underneath your feet? And as Norbert said, I mean, COVID has been the massive accelerator for a lot of these trends, and I think that's where you'll find opportunities. And look, I think this is a rotation of assets, right? Because if you sort of go hey, this asset does not fit the market or the needs anymore, something else needs to be done with it. So it kind of goes from being one type of property, which is maybe a well-let co-op office, to being a value add opportunity for somebody else at a different price point, where they have to do something else with it. So I think that's where the opportunity set is going to be to find. And again, in the debt perspective, the same thing. I think it's I think we've seen it in the press. I mean, some people have been caught out lending on retail. I think there will be others who get caught out lending on maybe the asset the office assets which are more impacted. But as a broad base, I don't think we are seeing massive NPL portfolio. At least from where I'm sitting, I just can't see that. And there's just so much liquidity in the market. It's hard to see how that arises.
Yeah, I probably agree with the sentiment from everyone there. I think what we have seen is a lot of lenders have, been busy with covenant amendments, waiver requests, and those standstill provisions will probably expire, in the coming 12 months, and then there's going to be, an event of some form. And the other important factor, I think, is the timing of valuations is going to be important. If they've been postponed, when those valuations come in, the values may have decreased in a lot of cases, and that will cause an issues for borrowers who are, typically used to paying like bank level margins, and they'll need to refinance, but there'll be a funding gap. So then they're looking at alternative debt providers to step in at increased, pricing. So they'll have to rebase, their investments, and that has a further knock-on effect. Is I think we'll actively start seeing assets trade. 2020 we saw assets come to the market. Debt providers weren't really forcing investors to sell; they were holding off. So investors were pricing assets, seeing what the bids were, and then taking them back off. We'll actually see investors having to sell assets now, and that will create opportunities as well.
Okay, good. Matthias, and I'm going to come back shortly as well also to because there's been quite a lot around debt funding gaps and those kinds of things. But Matthias, I wanted to pick up with you because you're in a position there, as well as being a lender, you're also a borrower. So I just wanted to pick up from you what your sense is at the moment as a borrower of the current market.
To put it in a nutshell, where the liquidity is. That means that our investors are very much looking on sustainability and everything we had earlier. What is the impact on location, on sector, etc. So also applies to our equity investors. So as long as we keep an eye on the liquidity of the asset itself, the transparency of the real estate market, and the availability of conservative equity, I think we're on the right way. When we seek debt finance from the lenders at all, which includes the banks, as Ali said earlier, especially in Germany to the majority extent. But when we ask for debt finance, we are typically in a niche between 45 and 60% loan to value, loan to purchase price, and what we can see is if I consider all three arguments having had earlier, transparency, liquidity, and the availability of conservative equity, we also have good support from the German, but also the European banking world. Does that answer your question, Richard?
Yeah, no, I think that's interesting. I've got a quick question has just come in as well from Douglas Edwards. Douglas, good to see you. Thanks very much for joining us this morning. How are you as lenders adapting your lending processes and strategy regarding ESG and wider regulatory changes? Interesting one. Obviously, ESG, very, very big topic. So I don't know who wants to start with that. I mean, I know Norbert from Berlin HIP's point of view that particularly carbon reduction, ESG has been a very big topic.
Yeah, definitely. I mean, as you mentioned, Richard, Berlin HIP has a bit of a tradition. I guess we started almost 6-7 years ago, before I joined here, with the first green bond in the European market, and we are at the minute, let's say, at a point where our existing portfolio, approximately 25% of it is what we call green, and our intention is to build this up to 30%. It's from my perspective really a very interesting topic, and maybe the next really, well, it is already the big topic when we think, let's say, the time hopefully after COVID. Why is it so? Because what started a few years ago in a way that it seemed to be a bit of a marketing activity, right? To say that you finance green buildings and that you issue green bonds to refinance those loans is more and more a part which became really big in a way that, in my opinion, the states, the state governments, the communities, the cities all over the world starting to use the financing vehicles to steer a bit the process, right? And to make sure that a lot of things which they want to see coming in regard to carbon reduction is, so to say, reassured by the way how those projects are financed. I'll give you one example. Here in Berlin, we have more and more discussions with the city of Berlin when they, let's say, want to sell land to respective developers. They ask much more and much more intensive about the purpose of that land and of that development in regard to ESG. And without the right and respective answers, you don't get the land, you don't get permission to build whatsoever. And when you see that, in my opinion, the necessity on investors' side, on lenders' side, on borrowers' side, whoever you talk to, is more and more important that you, let's say, see your portfolio of investments, of loans whatsoever, in the light of how ESG confirm is it. And of course, we started relatively, let's say, maybe late. We can say that. It is really the most interesting question. What are your specific targets, and what are your specific ideas? How you create a greener, a more ESG conform portfolio. And in that regard, I think that impact is already big, but it will become bigger more and more.
Norbert, I like it. And I'm with you, and I have nothing to complain about it. But 95% of all the existing real estate is already existing and yielding. So let me switch my hat and coming to the securities trading bank, where we arrange for a promissory notes and securities real estate backed. So I think what it also covers is that all these ESG and sustainability aspects and this energy consumption, etc., tick us a box in terms of liquidity. To create a liquid product and a sustainable product. But for me, and now with the other hat being more from the perspective of a lender, who would say it is a traditional factors and the impact on the availability of private debt is still the coupon.
So I think just from a global perspective, we're very focused on ESG. And Matthias, I'm sort of interested to debate this a little bit with you from that perspective. We're interested in it because our investors really care about it, and it's become a very material topic for them. But we're also really interested in it because as real estate debt investors, we're focused on underwriting positive credit migration. And that applies whether we're focused on, core senior debt strategies, looking at premiums to fixed income, or whether we're looking at value add real estate. And our research team have certainly demonstrated that over time, green buildings have seen more yield compression and higher rental growth than other asset classes. So although it's very important to our investors, and I think that's where this story has started, I think it's a critical theme across our industry as we underwrite investment performance too. And so I'm just interested how everyone views that in that context.
Yeah, look, I mean, I would agree with you. I mean, we've been fundraising for our fund. I've sort of met 80 plus investors, and I'd say different to last time. I think ESG is in the top 3 concerns or top 3 topics that every investor wants to talk about. And I think Europe is definitely a leader in this. I think they're sort of a thought leader in this space. I think one thing I'd say is, look, what this is driving towards, in my mind, is towards more capex and more refurbishments to kind of get assets to a level where, as you say, James, like tenants want it to be, right? But I don't think suddenly we're going to go hey, we all need new shiny new buildings which are all ESG, which are all green, right? But because ultimately, as Matthias said, 95% of real estate is existing, it's there. So I think it needs to kind of move towards that. And I think one of the big learnings for me actually has been, if you look at it from an ESG perspective, yes, the energy efficiency and sort of the green credentials of the glass in the building is obviously important, but there's also a big part of the embedded carbon in it as well, right? Which is the buildings that are already there. So actually, it may be more green for you to take an older building and get it from one point to another point, then to actually obviously knock it down and build like a very green building. So I think there are nuances around this, and I think ultimately this will be driven by investors, as you say, but also by tenants. And I don't think every green building or every green asset is going to be the same. I think there's going to be a variation, but I think the general theme is definitely towards that, right? But I think maybe sometimes when people say green, I think we kind of have a very specific building in mind. And that's probably where the disconnect is.
And I think, Ali, that's a really interesting point, just in terms of as we start to measure ESG more effectively across the industry from a real estate perspective and a lending perspective, I think we'll have a very clear idea of what we think actually fulfills those criteria in a way that has moved beyond the sort of simplistic definitions that I think we've started with.
Yeah, but maybe if I'm allowed to add that, and Jamie and Ali, I'm fully with you, by the way. I think that's a very core point. I guess when we are talking about green buildings, we are talking exactly not about the new shiny buildings people have in their mind. We are exactly where you were talking about. And give you one example. We are currently working on what we call the transformation loan as a product, and this transformation loan is exactly, you can call it another word for capex, which we finance exactly to switch brown assets into green. And we are talking about, and then you have another angle to the ESG topic when you talk about residential buildings, residential portfolios in bigger cities where the living costs are high, etc. So you can really create a great story out of that. And I'm fully with you that this is something where we are on the lending side, independent if we are talking from my side here, from the banking side, or from your side when you're talking to your investors into debt, that this is a very interesting opportunity for all of us to make that change and that shift from brown existing assets into new green buildings, ESG conform.
Yeah. Don't get me wrong when I'm not really jumping on that ESG train. So I would lovely finance an old building in the Munich city center. And I don't care about ESG if I have that opportunity. When I've said it tickers the boxes for liquidity, it is in reletting. And it is a tenant demand, absolutely. And it's my takeout risk, my refinancing risk. So if tax burdens or whatever has an influence on energy cost will increase in near future, then I will have a disadvantage in operating cost my old property, even in the city center of Munich. That will also apply to that one. But it is for me an liquidity aspect when I talk about credit risk. That was my comment, and thanks for having a chance to adjust that a bit.
I think COVID will probably be a catalyst for change, right, within the real estate industry, how we use real estate and how we utilize it. And it'll become a factor, in terms of asset location, covenant strength, how green is the building. It will just be another factor in consideration. What we have seen is we've seen lenders incentivize borrowers by reducing margins if ESG incentives are carried out, say by installing solar panels to secondary kind of industrial assets. But these assets with relatively stable WALTs and secure incomes. What we haven't seen generally is where, in the value add space, where borrowers are developing existing stock, very heavily, undertaking thorough refurb projects to turn them into grade A, kind of highly efficient office stock. And that, I think we're going to need more development or high yielding credit strategies to support ESG strategies. And where we have seen it is, we've definitely seen it in the shiny buildings. We're starting to see it in the capex where you've got income, but we haven't seen it in that high yielding space. So I think that's, I think Ali alluded to it. You're speaking to investors. It's much more on their radars now. So we'll start seeing that filter in.
Yeah, and look, I guess as a strategy, in our high-yielding strategies, we want to do more office refurbs because we think there's an opportunity there. And if you look at, if you have got well-located assets in city center locations, be it London, Amsterdam, Paris, Munich, Berlin, we think fundamentally that's good real estate, the good locations that have good amenities, good connectivity. And if you find a business plan where you are doing refurbishments or you are actually making it into something something that the tenants want, which is driven by ESG consideration and other considerations as well, right? I mean, they want different kinds of offices. It's not just ESG, it's ESG is part of that. We are all ears. We think that's good risk-adjusted returns there.
And I think, Ali, to that point, it's part of every investment that we're looking at in that space. When you're building stock that's fit for the market, it's become an inherent characteristic for a lot of those types of deals.
I think that's interesting, but it's also sparked Douglas to come up with another question, which is, will you bring ESG covenants in your lending documentation? That's a very specific one. Does anybody want to pick that up?
I think it's something that we're focusing on absolutely at the moment, and we're reviewing in some detail. There are increasing reporting obligations as a result of SFDR and other sort of industry-wide initiatives. So it's front and center.
Yeah, I just can confirm, because if you for example want to issue green bonds and to refinance those loans, you need to be sure that those financings have, of course, and reach the energy efficiency we, let's say, published and of course promised to our bond investors. And in that regard, you have, of course, to have covenants in that regard into your loan documentation.
Okay, good. We've got around 15 minutes left, so if you've got questions, do put those into either the Q&A or the comments, and I'll pick those up. But I wanted to pick up on availability of debt. So who's lending what where? Maybe let's start with you, Norbert, just first on that. So I suppose in terms of the banking side, what are you lending on? What are you less, what are you cautious on, and what are you less cautious on?
Yeah, I mean, we already touched a bit all the impacts we had and we see. From my view, most of all, we stick to our, let's say, core clients, experienced clients, clients with track records. We stick to, let's say, the countries I mentioned at the beginning, as well as the locations in those countries. We usually focus on A cities, A locations. We, of course, in Germany are a bit more, let's say, able to go out into other areas. Asset class wise, we do the typical asset classes. We have the, let's say, ability to go ahead with financing of office due to the fact that we still like office, but again also with usual restrictions. We let's say go also into retail with I guess it was Matthias, what Matthias mentioned, of course, with a bit let's say differentiating between let's say some specific retail things or some specific logistic things. But all in, I would say we continue with what we've done for a long time. Where I see really some impact is, of course, in the way to what extent we leverage. We are, of course, more careful. I would say usually we are not exceeding the 60% LTV. We want to see amortization if we're really a bit out of that. And then, of course, that's also mentioned, we see a lot of borrowers without the right amount of equity. And then, of course, they are bringing in mezzanine providers. So we are in these days also able and, of course, willing to work together with mezzanine providers to let's say to get things financed and done. So in that regard, I would say we don't think that it's the right time for new experiences or for new, let's say, from our view, more exotic things. And in that regard, looking at quality and doing the right things with the right people, I guess, is what I would say, how I would call it.
Okay, and is anybody else taking a more kind of adventurous approach in the market? Because obviously, as some lenders step back from other things, there are different opportunities arriving. So I suppose what's happening in that, which I guess would be slightly higher yielding space?
Yeah, so look, I would agree with everything kind of Norbert said. I think the way I see the market is in kind of two bits, right? You've got the momentum sectors, the beds and sheds, and the meds, as we call it now. And I think for me, that's all about location. But that's probably the easier bit to sort of get your head around. I think there are dislocation opportunities in the market, and they are not created all equal, right? So, for example, I think we are big believers in hospitality. We think like the fundamentals going into the COVID pandemic was actually pretty strong. Now the market has just changed around us, right? Because you're going to have much more in-country travel. You're going to have much more European travel. So the fundamentals are different, but that's kind of where somebody like us, who are effectively, we are effectively a real estate equity shop, right? We buy real estate. So to be able to overlay our real estate view and go, actually, that's good risk-adjusted reward for us. We see really good value in hospitality and some of the core locations. We also find really good value in some of the alternative sectors as well. So what we found, one of the learnings for us in the pandemic was actually student housing, especially in the continent, actually has performed much closer to like residential than it has performed versus a really operational asset class. So we think, again, there's good risk-adjusted reward there. Look, if you look at residential, everybody wants to do residential, right? But if you take those teams and go, well, where else can you take the alternatives for that? For me, self-storage is a great example, right? Because as houses get more expensive, people can't move. They need self-storage. So I think we've been big believers in self-storage. So some of these alternative themes are actually have really strong opportunities. And if you look, but they're small in scale, right? The big one is office. And I think for us, well-located office in good locations with good amenities, with good business plans, offer very compelling risk-adjusted rewards for us. And we think, that's a big part of the market. And whatever the impact is, look, I can't sit here and say, hey, I know it's going to be 5% or 25% impact. But wherever that impact is, I think our core thesis is that it's not going to be equally distributed. So there's going to be places where it's going to be much more resilient. And it's for us to really go, okay, well, where do we have conviction? Where do we want to take that, let's say, additional asset level risk? But we will not compromise on the location, and we will not compromise on the quality of the sponsor and the ability to do it. As long as we got those things right, we are willing to take more reposition risk in these locations.
I'm taking a very simplistic view on these things. If you lend money, you want to have your money back, and to assess that, it has various layers of assessment. So we had that on location, on sector, etc. So the experience we've made when we issue promissory notes and also securities is when we touch base, or if take collateral, accept collateral where we have no zoning or no construction permits, is that still a good risk to take? And the answer is it depends on partner quality, skin in the game. Is that equity invested, or is that future profits, etc.? So it is various, but everything is around, for me, sorry for saying that I'm very, very simplistic, and that is across various sectors, is if you lend money, you want to have that back, and everything is on your refinancing risk. So if you amortize in better risks over time, so that's a good thing. If you improve that by bringing in zoning or construction permits or delivering the property, okay, that's good. So the risk has been approved. And if that is, whatever it is, everything is, from my perspective, very much about your takeout risk.
Okay, good. Just had a quick question in here that I wanted to just pick up from Andrew Peterson. Thanks, Andrew, for that. Which country do we think the bid-ask delta on assets is the greatest? Which one most realistic? And what movements in deltas are predicted in the next 12 months? So there's quite a lot to unpack in that particular question. Does anybody want to pick that up? I suppose we're looking really in terms of countries where we see, I guess, the best opportunities, which are the most realistic in terms of pricings, and I suppose what sort of changes are we expecting to see over the next 12 months, really?
So maybe I'll have a crack at it. I think the fundamental question that is being asked is one about liquidity, right? Because when you have liquidity in the market, I mean, like, the bid-ask spread obviously naturally compresses. It's hard for me to say, like, what is the realistic price or what is the right price, because that is obviously, like, at that point, like, the price that somebody's willing to pay at that point. So I think that's a very hard question to answer. But if you ask a question around, like, where is, like, the bid-ask spread the smallest, I'd say, like, it's the most liquid market. So if you go into Germany, and then will be interesting to hear your views, Matthias and Norbert, we find very strong liquidity in the market still. You go into Benelux, I think you still find strong liquidity. Nordics, you're finding strong liquidity. UK, where you have, like, more pockets of illiquidity is probably where, like, in the Southern European markets now, partly because I think it's harder to tell what the actual long-term impact of COVID has been, right? But again, even then, I think it's very limited in terms of cities. So if you go into Madrid or Barcelona, I think there's still plenty of liquidity in those markets. But if you, like, maybe are in a regional city, it's tougher. So I think this is a fundamental question of liquidity. And generally, I'd say the overall sense is there is a lot of liquidity in the market. I think people are targeting in certain places where they feel they're more comfortable, and that is ultimately going to expand as we come out of this recovery, and people see, like, what the real long-term impacts are.
Yeah, I think that's absolutely right, and I think the other factor to bear in mind that there's been, a lot of the trades that have happened since COVID have been underpinned by domestic investors, supported, looking at investments in their own jurisdictions or within Europe. We haven't really seen investment coming in from Asia, other than a few kind of flagship trophy asset trades. And as soon as the travel restrictions are lifted, there's going to be a capital coming in from all over the globe, targeting areas which they're most comfortable in, which tends to be Nordics and Western Europe, and that will mean that the delta there is going to be compressed, and it will leave the pockets in other jurisdictions. It will become wider, and that will predominantly be around CE and Southern Europe.
Okay, good. And I just wanted to pick up on the point I mentioned earlier, which is around the sort of debt gap, because you'll have a lot of loans that will be, coming up in 2021, 2022, which may be problematic potentially. How do people see that? Is that a real kind of issue, or I suppose in some ways an opportunity for others in terms of the market, that sort of funding gap?
Absolutely. Every year across Germany, France, and the UK, about 100 billion euros of loans renew. So if you look out over the next 5 years, that's 435 billion euros worth of financing. Some of those financings are obviously getting extended in light of COVID, a significant proportion. And then more importantly, if you look at the dominance of banking in Europe, I think Ali referred to it earlier, it's about 90% of the market. The banking industry in Europe, by the way, is actually larger than it is in the US, in spite of its relative position in the market. So you have to look at what's going to be happening to senior lenders across Europe to really infer about what's going to happen about refinancing. And there you have regulatory change that is going to have a meaningful impact over the next few years in light of Basel IV. So I think we're estimating that senior banking will retrench by about 130 billion euros over the next 5 years, potentially, which does leave a very meaningful gap that's available to private debt investors, and a growing number of them across the sector.
Yeah, and to make it very exciting, I would also remind us on what we said, in this discussion. I mean, we have these two huge impacts: ESG. We have COVID. Of course, many others as well, but those two I would like to pick. And when you just take the example of office and the demand for office, we already mentioned it. There will be losers and winners when we're talking about specific office districts, buildings, wherever. And I think that will be a very, very exciting situation over the next years, when we will find out what are the winners, what are the losers. And the losers doesn't mean that they don't get refinancing, but of course, based on completely different terms. And in that regard, it will be really interesting to see how that gap will be filled. And I totally agree with Jamie. That could be a very interesting situation for new players, maybe, or players who come in and really would like to get into and to fill this gap in those specific areas.
And look, I guess the way I think about it is like, I mean, it's an allocation of risk, right? So as you say, like, you know, Norbert, I mean, like if you have like a core asset and it's clearly a winner from a cost of capital perspective, it obviously makes sense to sit with somebody like you where you have like much more effective cost of capital, right? The way you are taking much more transitional risk, like, you know, somebody like us who can like, look at it from an equity perspective and go, okay, well, we think this is where the risk reward is, and we can price for that risk, and we just for that risk, and that should sit with us. So I think for me, this is going to be a change in the risk allocation. And look, this has been happening over the last kind of like 10 years. I think UK is much more advanced in this, and I think this is going to play out in Europe. But I think there are enough players out there that like, you know, at least there's enough liquidity out there that like, you know, we think it's going to get allocation. But it's going to be a changing risk allocation, risk moving from one person to another, and asset classes moving from one type of asset class to another type of asset class.
I think, Ali, there's also going to be a tremendous opportunity, though, for the non-bank lenders in what I think of as the traditional bank lending space, too. And in that area, it's, you know, as insurance companies, as pension schemes, when they're targeting investments that are alternatives to fixed income, actually they can offer a very, very competitive cost of financing in the European market. And so I think there's both that rotation that you're describing and fragmentation across those different credit segments as we look at the market.
Yeah, I agree. I think the one thing I'd say is like, look, I mean, if you're an insurance company, I mean, like you're going to target maybe the A cities, the A buildings, like, you know, for a certain size, right? But somebody like Norbert, who has a much more broad-based network, I think like, you know, they will have a structural advantage around like, you know, what they can actually do and what they can't do. So I think there's going to be space for everybody in the sense that they're going to be assets that like, you know, the banks will understand just better because they have people on the ground, they just know it better, and they have a better view of the asset. But there will be assets like, you know, where we'll go actually like, you know, their risk reward means we might understand it better. So I think it's going to be about that allocation of the right risk reward spectrum where people understand the asset and they price for it. And I think it's just going to be that sort of diversification of providers that's going to be happening.
Yeah, there'll be more pockets of capital available, more pockets of more options for borrowers, and the landscape's going to be, you know, it'll just be busier to navigate, and it will keep us busy, you know, as we assist, you know, borrowers in finding the right debt product for their assets, and there'll be a bottleneck. There'll be all the 2020 refinancings coming up that have been probably standstilled for the last 12 months. They'll need to be refinanced this year and going forward. So we'll all have that to look forward to as well.
Now we're right up against our time, but I just wanted to ask one last kind of question to everybody in terms of, let's look forward in terms of opportunities. So where do we think the opportunities are if we're looking particularly at the European markets and we can choose an individual market or a sector or whichever we choose really? But where do we see the opportunities at the moment in this kind of debt space? Let's start with you, Ali.
So look, I think I see it across the board. I know that's a bit of a cop-out answer, but actually, like, you know, I mean, we see it in the momentum sectors. We really like logistics. We think, like, you know, Germany, generally Northern Europe, the fundamentals are very strong. Again, similarly on residential, it's all about location. But I think we also see very strong opportunities, as I've said before, in some of the dislocation opportunities as well, hospitality, some of the alternatives as well. And I think we actually see opportunities across the capital stack. So in whole loans, in mezzanine, in construction financing, also in JV equity and in pref equity as well. So I think actually the opportunity is very broad based. It's a stock picker's market. You have to understand your real estate. And if you do, there are opportunities all across the board.
Okay, good. Thanks very much. Deepak.
First, to pinpoint a specific sector, I'd say hospitality. I think it'll bounce back as people look to travel. And right now, you're seeing tickets being done at like 50-55% at kind of 600 over in central city, city centre locations, which are going to bounce back very, very sharply. So I think the opportunities there, people will start travelling again. So I think the hospitality sectors, particularly on the leisure side, will bounce back, and there'll be opportunities there.
Great, thanks. Jamie?
I think the biggest theme that we're starting to see is, and again, this is an acceleration of a trend that already existed, is the operationalization of real estate. So as we look at it, that applies to virtually every sector that we've been talking about. You can see it in offices as offices start to be more flexible in different terms. How do you actually manage the assets that you have to the best effect of the tenants? You can see it in, obviously, hospitality, student living, and even in the retail segment of the market that will eventually come back. I'm not necessarily, looking at it right now as intensely, but it's how do we look at how we're managing the spaces that we're in order that they remain relevant. And I think that's the theme that pervades all of the investments, whether we're looking at those very conservative senior loans or high yield transitional strategies.
Okay, great. Thanks very much. Norbert, what's your take on it?
Maybe I wouldn't refer really on countries, even of course we have to stick to some countries, but it's, I guess for us it's more important really to look at the metropole areas where we can be active in Europe. And that means to me, of course, more regions maybe in Germany, because we just have a few bigger cities here and areas. But anyway, interesting definitely in France with Paris, in Greater Paris area. We hope to go back one day to London, where we were before. I'm still working on it. And of course, we are also interested, for example, in Warsaw and also other metropolitan regions in Poland, which we find quite interesting. Of course, our asset classes, we are very conservative here. But again, it is more to find the right places, what we just said, for the respective asset class. So the right office area, the right residential area or areas when we were talking about portfolios, and logistics centers. Of course, we have the typical European regions where logistics is really important, and there we love to finance logistics. So in that regard, keeping or focusing on the areas where we think where it's vibrant and where things really are going to happen, and there we are more than happy to finance.
Great, and there'll be a very warm welcome for you in London when you can return, Norbert. Let me assure you.
Thank you very much.
Good. And last but very much not least, Matthias.
Well, there's not so much to add what my colleagues here on the panel said. I think it's a saying from the stock market: never catch a falling knife. So when it comes to our debt investment strategies, we very much focus on the transaction risk profile and again the classic criteria we had mentioned earlier, or at least where I'm of the opinion of and the believer in, that is the transparency of the real estate markets, the liquidity of the underlying product, and the availability of relatively conservative equity. So if we don't see one of these three factors, we certainly think twice before we provide debt investments into that product.
Great, thanks very much. Thank you all for sharing your insights with us today. Really interesting discussion. Thank you as well for your questions and your comments. I hope it's been useful. One of the joys of it being live is that we can answer your questions and pick those up live. You can connect with one another. So everybody who's an attendee can connect with one another, send messages, even have video chats after this. So do feel free to use that. And also to look at the other events that are coming up. There's obviously the France investment briefing is coming up for those interested in France. But we've got a number of topics coming up over the next couple of weeks. Thanks very much for joining us. Thank you, speakers. Really interesting conversation, and look forward to seeing you, everybody, at the next event. Thanks very much for joining us.